Thanks, Tim. Well, we might roll straight onto the next slide if you don't mind, and maybe one more, and we'll talk about IMDEX. As you point out, it's a global mining tech company. We do make a distinction between mining tech and mining services. Australia has a very big portfolio of mining services companies, and as a mining tech company, we distinguish ourselves to the extent that we tend to be capital light compared to a lot of mining services companies, people light compared to mining services companies. We are global. Only about 20% of our revenue comes from Australia. We're commodity agnostic, and we have a reach into about 70% of the world's mining activity. So we tend to find that we don't have a lot of contract risk either. And all of those features, I think, are attractive elements of our business model and separate us from the way that a lot of people evaluate mining services as a space. And it's obviously an attractive space to be in. Moving to the next slide. We just reported our FY22 financial highlights. And for us, a number of key themes, obviously record revenue, record EBITDA, record NPAT, and a record dividend were all highlights. But probably the key feature for us is on the bottom left of the screen, the EBITDA margin at 31%. That's the third consecutive year of EBITDA margin expansion that we've achieved. But there's really a hidden element inside of that number that we are particularly attracted to, and that is obviously there is good operating leverage in the business model. It is a key feature of the business model. It's a good quality business model, in that as that record revenue, or as each dollar of revenue comes in, we get very good leverage into the EBITDA line. The incremental margin that you can see with 29% record revenue and 39% record EBITDA highlights some of that. But in addition to that, during the year, we've absorbed a significant amount of costs that are looking to stand up a new business unit as we move into the mining production phase and as we execute our digital 2.0 strategy. And so we expense those costs as we stand up those programs, and that EBITDA margin and that EBITDA margin percentage would be better in terms of evaluating the core operating business itself. If you roll forward to the next slide, you can see that our 5-year compound annual growth rate in revenue at 14%, we set ourselves a very clear bar at ensuring that we grow above the market rate. And the market proxy we use is the S&P Global Exploration Expenditure, which over the last 5 years at 9% sits below our 5-year CAGR of 14%. And again, looking to the right on the slide in front of you, you can see the benefits of that operating leverage in our business model coming through in our 5-year EBITDA CAGR and that progression in our EBITDA margin, which have been very strong features, and we expect those features to continue as we look through FY23 and beyond. Moving to the next slide. That growth profile, I made a point at the beginning that we are a truly global mining tech business. We've seen very strong growth in the Americas, Canada, USA both, and then strong amount of investment is starting to flow into South America at the moment, which during COVID was probably a little slower to recover than some other regions, as was Africa. And we're now starting, as we enter FY23, to see significant exploration money start to head into that African region as well. The APAC region has been very good for us. It experienced very strong growth coming out of that initial COVID bounce. Rig utilization in that area is pretty high, but we're seeing all of the drillers increase their rig fleets, and we're seeing all of the resource companies increase their budgets. And so that strong growth we saw in FY22, we expect will continue to be, we'll have growth as we move into FY23. Rolling forward to operating highlights. No good financial highlights occur without some good operational fundamentals underneath it. From reading across the top of the slide here, obviously focusing on our people, and we've identified our health and safety improvements in the form of LTIFR, but we also focus very heavily on employee engagement, both HSE engagement and overall wellness engagement of our workforce. And for that overall employee engagement, we use Gallup as a firm to come and measure our improvement. I think the highlight here is that over the last 2 years, Gallup has reported employee disengagement has been rapidly growing in workforces around the world. And some of you will have heard of that in the form of the Great Resignation and the like. Whereas at IMDEX, we have gone against that trend, and we've seen heightened employee engagement across all countries and all facets of our business, which is pleasing. Moving along, obviously we place strong emphasis on our ESG, both the footprint that we cover as a business, plus our ability to help other organizations. And the third-party agency Sustainalytics completed a review for us and have rated us low from an ESG rating perspective. Those are very important features of our business. Really, though, on the bottom left, the real heroes of our business for the year were the supply chain team who kept everything moving under significant duress, and we're seeing really great results from that group. We would not have had 29% revenue growth were it not for that team. Moving forward onto R&D, onto the next slide. We do expense about $30 million a year in research and development. A small amount is capitalized, but the majority is expensed, which is a very conservative position that we take in how we manage our earnings. And what we seek to do is make sure that our shareholders understand that we deploy that R&D effort across a number of horizons. Horizon 1 is protecting our core business and ensuring we have the next generation of products coming through. Whereas Horizon 3, on the other hand, is how we invest today for products that might unlock material revenue for the business in 3 to 5 years' time. You can see that in FY22, we had a significant growth in Horizon 3 as we brought our BlastDog project through to commercial prototype. And as you go into FY23 and beyond, you'll see that number reduce and you'll see the growth in Horizon 1 and Horizon 2. Moving forward. Very strong balance sheet. The fact that we expense our R&D makes for a conservative balance sheet, and we always maintain a net cash position. We do that because of our exposure to the exploration cycles. But pleasingly, obviously a very strong return on equity and return on capital employed. Once again, a key feature that is attractive about a mining technology company as distinct from a mining services company. And we've continued to invest throughout the cycle in new technologies. If we keep moving forward, please. The outlook for our industry remains pretty strong. We see very strong commitments from drilling companies to increase their rig fleets. Most of them have order books that are typically 3 or 4 months forward visibility, but today they have 9 and 10 months forward visibility. And that's a level of confidence that that industry hasn't seen for some time. And most of the major producers and tier 1 resource companies have all announced increases in exploration budgets. Again, those are the fundamental drivers that underpin our business. There is some uncertainty about junior and intermediate financings out of the TSX, but I think that's counterbalanced by some of the commitments you're seeing from the majors, which account for far and away the largest number of, or the amount spent in this space. Moving forward. Our bulk of our revenue today comes from our core business in the bottom left of this strategy quadrant, but we've made a very clear statement about how we are building our solution selling in that area. The R&D and the acquisitions that we make address the 2 boxes to the top of that quadrant. And really excitingly, it's our expansion from exploration into mining production that is really driving our strategy delivery today. And we'll roll on to the next slide and I can elaborate on that a little bit more. Our extension into mining production on the next slide seeks to highlight some of the progress we've made in building products to go into this space. We have very strong core capabilities in fluids and sensing tools. It is the same technology, it is the same ore body, it is the same asset owner in the production phase as it is in the exploration phase. So what we are doing is just tailoring our products to ensure they suit the workflow in that production phase. And we saw significant progress with the BlastDog contract that we announced in August of this year, the first commercial contract of its kind, and the economics of that business are very attractive. If we could move forward to the next slide, please. The benefits of the IMDEX mining technologies focus around ore body knowledge. What we seek to do is to ensure that we help resource companies understand the ore body to the maximum extent possible, and that impacts every downstream activity thereafter. And the ability to give that information should make for a much more efficient mining industry and unlock precision mining opportunities and tier 2 deposits that have previously been inaccessible. Rolling forward, our focus for FY23 is about continuing the development of that mining production solution and the software that supports it, prosecuting our Digital 2.0 program, which focuses on optimizing our cost base and always protecting our people. And moving to the last slide, our outlook, as we've started FY23, has been strong. Our revenue growth in July was above June, and we've seen strong growth again as we are looking to round out Q1 this year. And the underlying fundamentals for our industry have never been stronger. And I'll probably leave it there, Tim, and hand over to you for some Q&A.
Bang on time. Thank you, Paul. There's quite a few questions coming through. One is, what do you think is kind of reasonable expectations for medium-term earnings growth, and what's your kind of main macro risk?
Right, so we don't give guidance about earnings growth, but what I will say is we use that S&P proxy in terms of exploration expenditure growth, which is a published number. And because of the investment we make in R&D and the capability we have, we always look to grow above that number. And that's within our core business. Add to that the growth potential that comes as we extend our offering into production. And we're looking obviously for some strong top line growth. And as we stand up that new business unit, whilst there'll be some cost to stand that up in the beginning, the economics of that business unit will be as strong as our core business.
And Paul, there's a question here on your Blast Dog rollout post the commercial prototype phase. Can you give us some sort of expectations around winning market share over the next 3 to 5 years?
Yeah, we're looking to, the way we take that product to market is to work with resource companies to understand first and foremost each ore body and the unique challenges that that ore body may have. We then aim to conduct a trial where the definition of success for them and for us is determined at the outset. We're learning as much about our product as they are about their ore body during that trial phase. And at the conclusion of that, we're obviously looking to see whether we can better inform them about their ore body than they can without Blast Dog, and then convert trials into commercial contracts. We're testing that in, the way we're testing that at the moment is in bulk commodities and in copper. We have trials in those commodities underway as we speak, and we'll look to roll that out in the Americas and Australia first and foremost. After that, we'll then look to lithium, nickel, gold, and we'll look to other geographies.
And you spoke about the supply chain. What's the outlook there? And can you talk through some of the labour pressures you may be seeing?
Yeah, look, the supply chain, I think, has been strung like a piano wire probably for 2 years. Pleasingly, we are seeing signs that those supply chain pressures have been improving for us. Whereas we used to have most of our product on the water on the way to its destination, it's now in the warehouse ready to be drawn down by our clients. I do think that they're probably susceptible to a little bit of risk if there is further disruption, but right now they're in a good space. I do think labour will remain a challenge for the industry at large. And although IMDEX is labour light, our clients do have a labour challenge, attracting them to the industry, keeping them in the industry, and then once they're there, keeping them safe, recognising, of course, that when people are unwell, whether it's COVID or other reasons, non-attendance or absenteeism at workplaces is higher now than before COVID. And unfortunately, drilling is not a working from home activity, Tim.
No, it's not. And now talk about the critical minerals industries. How do you work with these kind of new industries, if you like? You know, rare earths, there seems to be a rare earths discovery all the time. What sort of demand do you see, and how does that impact IMDEX?
Yeah, look, it is by far and away one of the most exciting and fastest growing areas. And it's not just lip service, you're seeing actual activity on the ground. Historically, copper, cobalt, nickel, and lithium would have accounted for 35% of exploration spend. But what we see today is that new projects across those critical metals commodities, across that bucket, is closer to 65%. And over time, you'll start to see the weight of that on total S&P exploration spend. The reason for that is whether it's consumer behaviour, automotive supply chains, government policy, or the policies of the finance sector about who they lend to and who they invest in, every element is now placed very clear policies and pricing around how they will support industries that are driving towards sustainable outcomes. And hence that demand for critical metals, I think, is going to be one of the greatest opportunities facing our sector for many years to come.
And just finally, Paul, can you talk about M&A strategy and how you go about acquiring new verticals, new products versus creating those products internally?
Yeah, we always have a choice. So we talk about the ABCs of growth being acquire, build, and collaborate. Whenever we do have a strong R&D capability, and so whenever we look at an acquisition, we also thoroughly prosecute the idea of building out a solution ourselves. Specifically around acquisition, we look at smaller emerging technologies and the opportunity to, if they're on strategy and if the culture is a fit, to bring them into our suite of offerings, leverage our global network, which is probably one of our strongest and most unvalued assets, is the ability to take products to market. And we obviously have the balance sheet capability to look at larger acquisitions should they present, but we are very disciplined around how we undertake valuations and how we actually, how critical we are about strategic fit and cultural fit before we embark on any acquisition.
Paul, that's all we have time for. Really find IMDEX a fascinating story. Have a nice weekend.
Thanks, Tim. Thanks. Appreciate the chance.